Welcome to Module 17. Let's talk some more about costs and making decisions. The key of 16, we talked about variable and fixed costs. We did the CVP analysis stuff and cost volume profit analysis. Now we're going to be looking at relevant and irrelevant costs. Well, what the heck is an irrelevant cost? Are our costs relevant? Well, actually, we've got things like sunk costs we'll talk about that we really don't use or bring to bear when we make decisions on how we're going to process and how we're going to evaluate what we're going to be doing. So let's start with relevant and irrelevant costs. Relevant costs, yeah, we factor those in. We look at the differentials between the different alternatives, and they are very relevant. But then we have these irrelevant costs, which are future costs that do not differ among competing decisions. So they're not really relevant. They may very well be costs of what we're doing, but they're not relevant to the decision because those costs are going to be the same if we're deciding between two or three alternatives. Then we don't need to include those costs as part of the decision-making process. So additional factors, by the way, we're also looking at non-quantitative factors. It's not all about the money all the time, and the effects on long-run profit. We might have some short-term versus long-term considerations we need to look at. So if we go a little deeper dive, we talk about revenues and our future revenues and our outlay costs. So our future revenues, we get different amounts of sales that will be generated depending on what we do. We also have different amounts of future expenditures, of checks we need to write, of cash we need to pay for other resources as we go to generate those future revenues. So what the heck is a sunk cost? Well, sunk cost is done deal. We've already got the equipment, we bought the machine, we have the facility. These costs are never relevant. You say, wait a minute, if I spent $1 million on a machine, you tell me that's not relevant? Well, we've already spent $1 million. We already have the machine. Now, is that going to make a difference in our decision if we're going to buy a new machine or go in a new track or a new direction? Yeah, true, we don't have to buy additional machinery that could be used for other products that may be able to use that same equipment, but we need the differential. If we need to make an evaluation, if we need to make a decision, sunk cost is a sunk cost. We already bought it. We got the desks and the chairs. We don't have to buy more desks and chairs. That's already a done deal. As far as our ethical dilemmas, managers often, we got to be careful on how profits are recorded. We've talked about inventory that can include labor and overhead in addition to materials. That also may take away some of the labor that would show up on our income statement as a wage expense, putting it in inventory and affecting our profit. And disposing of old assets. We may have obsolete inventory that is on the books for a certain value, and if we get rid of it, we're going to have to take a loss or take a write-off on it. That maybe if we kept it in inventory and could possibly sell it, we would not have to devaluate it. So managers' performance is often dictated by financial implications of decisions that are made, and they may affect what we're doing that is best for the business. I was actually talking this past weekend at a colleague, and he was talking about how in a manufacturing environment, and this is the automakers, different divisions saying, you know what? Well, if we fix this thing, we're going to have lower warranty costs. But to fix this thing, we have to buy a die, and for casting, that's going to be super expensive. And for the company, it would have been better to buy that because they'd cost $500,000 to buy whatever they're going to buy, but they save 5 or 10 million in warranty costs. But they're saying, oh, but the warranty costs are covered by another division. That's not my division. I'm not going to buy this piece of equipment. So for the good of the whole, that's not where they're looking. They were looking for the good of the division. And with that, it adversely affected the profitability of the company as a whole. So disposal and salvage values. So disposal value is something we can sell an asset for. All right. And it's the cash that won't be paid for a trade-in or selling to another party. It's like if you're replacing your car. You go out, you buy another car. Do you trade the car in? Yep, sometimes you get a value for that. Do you sell it in the open market? Sure, you can do that. You get a value for that. But you do take that factor into account if you're trading in a vehicle. Say you're getting a truck. The cost of the truck, the new truck, is impacted by trading in the old truck. There's also a salvage value at the end of the useful life. We talk about that in depreciation. So if we buy something, piece of equipment, a building, at the end of its useful life, there's still a value associated. And so we need to take that into account as well, potentially. And then relevant cash inflows associated with any replacement alternatives that we so choose. We also have opportunity costs. Well, if we make a decision to use our facility to make one item, we can't make the other item because there's only limited space, limited resources, limited people. So we have an opportunity cost by not doing something as well as by doing something. So we reject one alternative in favor of another. The benefit that is foregone is a lost opportunity cost. And it is always relevant when making decisions between competing alternatives. And then we look at the summary here. We have sunk costs are never relative and opportunity costs are always relevant. So we're saying, well, never say never and always don't always say always. But here, true. Never relevant, sunk costs. It's already done. It's not going to impact our decision. And opportunity costs, what else could we be doing does make a difference. If we could be using our resources in other directions for other opportunities. The deciding factor is whether or not a cost is relevant is the cost differs among the alternatives. So the marginal change between 2, 3, 4 alternatives, that is what is relevant in our decision-making process. I'm going to merge this section and we're going to continue onward with analyzing relevant costs and looking under different decision scenarios. So here's Nike. You've heard of them. Athletic apparel. Selling price of $20. Sells 10,000 shirts annually. Well, they now have the opportunity to replace a machine with a new machine. So here's the new machine. The old machine costs 50. It sounds like a sunk cost to me. Proposed machine is 45,000. There's a salvage value associated with the old machine, and there's a salvage value with the new machine, and we have an estimated useful life. So let's take a look at relevant and irrelevant. When we use different machines, we have different efficiencies. The newer machine, actually, materials are going to be the same, whether we make it with the old machine or the new machine. But the conversion cost, which is direct labor and variable overhead, is going to be different. It's actually cheaper on the new machine. So we get a cost savings of about $1 a unit. Selling and administrative are going to be the same. So again, that will not directly impact our decision. But during inspections are cheaper or less expensive with the new machine. So what's relevant? Conversion cost, disposal value of old machine, inspection costs, and cost of the new machine. Irrelevant, direct materials, no change. Selling and admin costs, no change. Cost and related depreciation of old machine, done deal, sunk cost. And the selling price of shirts, no impact. So we don't have to look at the revenue side because it'll be the same with whichever machine we run with. So we use what's called a differential analysis. We're analyzing what's different between the old and the new. And that focuses on costs that are different between the alternative actions and choices. Preferred over an aggregate analysis, you could still do, well, the total sales revenue, I got all my costs associated with the old machine, total sales revenue, all my costs with the new machine, and bottom line, you'll get the same answer. It's just that you're duplicating some of the calculations saying, well, materials isn't going to change. Do I need to include it? No. So what the benefits included are focusing on only items that differ. There's fewer items to analyze, and it just basically simplifies the decision-making process. So that gives us a flavor on some of the decision-making that we'll be doing and some of the terms you want to be familiar with. We're going to do a deeper dive into a whole bunch of different decisions that get made to process further, in-house or out, contract out. We'll take a look at some of those in the next couple of videos. Thank you for sharing your time and look forward to seeing you shortly.